Hello, this is Super Informed Radio, a UniSuper podcast. My name is Lyndon, and it is the first business day of March in 2026, which means we are here to check in on investment markets, what's been happening and what might be on the horizon. With me in the studio, as always, is UniSuper's Head of Fixed Interest, David Colosimo. Hi, David.
Lyndon.
Now, we can't escape the fact that it's been a big weekend geopolitically with the events that are currently unfolding in the Middle East. So in a few minutes, when David and I actually come to talk about what's on his radar over the coming month or so, we're actually going to be joined by UniSuper's Chief Investment Officer, John Pearce, for a few quick questions and to get his thoughts. So do stay tuned for that. But all of those events actually happened after markets closed for February. So, David, I think let's start by recapping the month. It is the shortest month of the year, as you're aware, but there was still a lot happening, including here in Australia, where shares were really strong.
Yeah. Australian shares were up 3.75% in February. Makes it the strongest month since May of last year. And you don't see that often, but that's actually quite a big outperformance compared to the US, where shares actually fell slightly in February. They were down a bit less than 1%. But that small fall doesn't really tell the full story because there were really sharp moves in both directions. It just so happens when you average them out, you get the whole market close to flat there.
I guess it raises the question, David, what has been driving those divergences? And I mean, I won't be surprised if you say it's AI, because it usually is. Am I far off?
Yes, Lyndon, I think you're on to me there.
Okay.
If we're talking about AI, then let's start with the losses first. I suppose by market impact, the biggest losses were in the Magnificent Seven. So let's think of four of those companies: Meta, Microsoft, Alphabet, which is of course Google, and Amazon. Now, these four companies have gone all in on AI. They're the biggest investors in data centers and the associated infrastructure. Now, they're actually all still enjoying quite strong earnings growth. They're delivering upside surprises, so the business is still going quite well, but they all guided to a big increase in investment spending. We're now looking at $650 billion between the four of them for 2026. That's more than 50% jump compared to 2025. It's now about 2% of US GDP. So if you're putting that in context, that's those four companies spending more than half of all residential construction in the US. Now, these companies used to be cash generation machines. But now all of that cash is being spent, all of that profit being spent on investment. So they're all going to have to borrow heavily rather than just spending out of profits, which is what they used to do. And so really the market's becoming concerned whether the returns they're going to see on that spending will be enough to justify the spending. All four of those companies that I mentioned are down between 8 and 12% in February. I think if you think about the recent announcement by President Trump as well, that these companies are going to have to generate their own electricity, that's additional cost as well, so that doesn't help them either. Now, even NVIDIA, which is the biggest beneficiary of all of this investment spending, its shares also fell by 7% in February, even though it had a bumper earnings result. It eclipsed very strong forecasts. So I suppose in that case, it just goes to show how much good news is already in the share price. Now, if you think about other companies, there are a couple of developments I think are important. Anthropic released a new update version of its Claude models early in February. And as for financial markets at least, there was a really viral social media post about the social upheaval that awaits with large swathes of workers losing their jobs. Now, even though I think most people saw that as a very exaggerated version of the future, it really did increase the emphasis on which companies have business models and earning sustainability that are most at risk of being disrupted by AI. So software companies are really at the forefront of that. Expectations that their pricing power is really going to be eroded. So companies like Intuit, Adobe, Salesforce, down 18%, 10%, and 8% respectively. You saw tech services company IBM down 22%, financial data provider Standard & Poor's down 16%. So damage across quite a lot of sectors there.
Yeah, it's very, very widespread through tech then. What about other sectors, David? Were other sectors impacted as well?
Well, I think there was also a lot of damage in the financial sector, particularly in the alternative asset managers. So they do private equity, private credit, which have a lot of exposure to many of those AI disrupted names. So if you look at a company like Blackstone, Apollo, Ares, KKR, they were all down more than 20% in February.
Rattling off quite a number of big losses there, David, and losses in some pretty big companies, no less. So how, in light of all of that, how was the market basically flat then?
Well, I suppose it's because there were so many more companies who actually gained in February. So I did mention earlier that the Broad Index, which weights the 500 biggest US companies by their size, that was down about 1% in the month. But if you look at the equal weighted index, that was up 3.4%. So actually some very broad-based gains in a number of the smaller companies. Now, as a starting point, I'd say that not all tech was punished. You think about all this AI investment. So there's a lot of equipment and hardware companies that actually did quite well because of all that spending. Applied Materials, for example, was up more than 15%. Now, in terms of the other gainers, it doesn't matter whether they were cyclicals or defensives, but investors have been rotating into companies they think will be resilient from the AI disruption, either because of their business model or because they have a really large tangible asset base. Consumer defensive names like Walmart, Costco, Coca-Cola, Procter & Gamble were up between 7 and 10%. You're looking at asset-heavy industrial names, so GE, Caterpillar, John Deere. They were up between 11% and 19%. Utilities were up, materials were up, energy was up, healthcare was up. So it's quite a long list of companies showing gains.
And was that all to do with AI disruption, David, or were there other factors playing out there as well?
No, you're right there, Lyndon. There were other factors at play. I think the big one was that energy was boosted over the course of the month because of higher oil prices, obviously as the US military did increase its presence in the Middle East over the month in preparation for those attacks over the weekend. The second thing is that the companies that rely on imports really benefited by that probably temporary reprieve from tariffs, given that the Supreme Court overturned many of President Trump's tariffs. And then third, I think the US in particular, if you're looking at the recent economic data, the economy and particularly the industrial side of the economy does seem to be accelerating again this year. And then finally, we did see a fall in bond yields from all of those AI and geopolitical concerns, and lower bond yields helps to support the market as well.
So not everything is AI then, David?
No, not everything.
Okay, time is getting on and we still have a lot to cover. We've spoken a lot about US markets already, but anything extra from reporting season there?
Well, we have covered a lot of it, but it does look like another strong quarter. Earnings growth about 12 to 13% in the US over the year. Now, obviously, much of that is still in tech. But plenty of companies delivered good results, upgraded near-term earning estimates. But it just seemed like the market was really more focused on the durability of earnings in the longer term. So often you still saw some of those share prices marked lower.
Very good. Let's turn quickly to Australia now, David. Did those US market themes that, did they sort of carry over to us here?
Yeah, they did. But in Australia's case, actually really worked in our market's favour. Now, our software sector, it was also crushed. WiseTech down 18%, Xero down 11%. But that is really such a small part of the market. Instead, the Australian market has lots of those asset-heavy cyclical industries that the market seemed to love and has been rotating into. Now, the big miners are the perfect example here. BHP and Rio up more than 15% and 10% respectively, even though iron ore prices were actually lower in the month. And utility and energy here was also stronger.
Now, it's been reporting season here in Australia as well, David. So did that have a big impact on markets at all, or any impact?
Well, overall, it was actually a pretty good reporting season. Number of companies beat estimates. They increased their guidance. which I suppose is consistent with the fact that the economy was picking up in the second half of last year. Now, the biggest gainers were the banks. They all beat on revenue, lending and deposit growth is strong, impaired assets are falling, bad debts very low across the sector. CBA and NAB, the highlights there, they were up 17% and 13% respectively. And I suppose if you're looking for negatives, the biggest one was again CSL. They missed their earnings estimates in the first half, down another 19% in February, now down more than 50% in the last 18 months or so. Now, management's still claiming that they will hit their full year number, but of course that will require an even bigger turnaround now.
Anything else, David? Before we look to the month ahead, is there anything else on your mind?
Well, we did have the landslide election victory by Japanese PM Takaichi in early February. She now has a very clear mandate to pursue aggressive reflation policies. So the Japanese market was actually up more than 10% in February. And if we are talking about strong markets, also just noting Korean shares were up nearly 20% in the month. So big companies there like SK Hynix, Samsung, they're both likely to benefit from all of this big AI investment.
Well, joining us on the line now is UniSuper's Chief Investment Officer, John Pearce. John, hello and welcome.
Great to be here once again, Lyndon.
John, of course, the big news of the weekend has obviously been the bombing of Iran by Israel and the United States. Now, you have repeatedly said that geopolitical events tend not to have a lasting impact on the economy and markets. Is that still your position in relation to these events?
It certainly is, Lyndon, and we should bear in mind it wasn't that long ago that the USA and Israel did bomb Iran, and the market reaction didn't last long at all. As a matter of fact, it was pretty much shrugged off. I'll also refer back to a far bigger geopolitical event, and that was, of course, Russia's invasion of Ukraine. There was an immediate reaction, of course, in terms of the oil price and gas prices, etc. And of course, it was followed by sanctions, so there was constraint on supply. Yet here we are today, and Russian production is pretty much where it was pre that invasion of Ukraine. And in fact, gas prices and oil prices did settle down pretty quickly after that invasion.
And obviously, John, you don't have a crystal ball in your possession, but in your view, how does all of this play out?
Well, we have to deal with an immediate shortfall of about 2 million barrels of oil a day, and that's the number that Iran exports. On top of that, we've got an issue because the Strait of Hormuz, where about 20% of oil is shipped, that's pretty much closed at the moment because of these tensions. So not surprisingly, we are seeing a spike in the oil price. It's up about 12-13% because of those events. However, I don't believe that the base case is that this will be that'll go on for much longer. Firstly, the oil in the world is in excess supply, and particularly with the OPEC countries, we can make up some of that shortfall. Big oil importing countries such as China has got large strategic reserves that they can call on. And I expect that the Strait of Hormuz will be open reasonably quickly mainly because you see Iran's military capability is being very severely impaired. So I don't see there's going to be lasting pressure brought to bear by Iran. So I'm expecting that notwithstanding some short-term volatility, we'll get back to business as usual in pretty short order.
Now, John, I have to ask, I guess the question on everyone's lips is UniSuper going to be adjusting any portfolio settings in response to these developments? I mean, it sounds like that's a no, but what's your thoughts there?
Yeah, the short answer is no, Lyndon. And I will say that, as we speak, as we're recording, the response by the Aussie market to those developments is actually quite muted. So it seems to me Aussie investors have taken it in their stride. I'm looking at US futures and they're a bit weaker, but I don't see any signs of panic at this point, which is very good. Indeed, if we do see a much more severe sell-off, we'd probably see it as a buying opportunity.
Okay, no worries. Well, John, it is always so great to hear from you. And again, thank you for making the time to join us today. Great to have you with us.
Always a pleasure. Thank you.
David, we've covered off the Middle East with John just there. In terms of everything else, what are you going to be watching out for this month?
Well, obviously, John has covered off on the developments in the Middle East, but otherwise, I think a bit of a focus on China's National People's Congress, which starts on March 5th. The government will be laying out its details of its 5-year plan and also announcing its annual growth target for this year. So there is speculation that the government will signal they will tolerate a slightly lower growth outlook of 4.5% to 5%. And also, maybe not as soon as this month, but it does feel like 2026 is going to be a year of big IPOs.
And what is IPOs?
Initial public offerings.
Very good.
So the race is on to see which of SpaceX, Anthropic and OpenAI, or private companies, will be the first to go public. Now, all three of them have AI platforms. And it does feel like Anthropic is actually leading the AI race at the moment with their Claude product suite. But they did have a recent decision to restrict their product use by the government in terms of mass surveillance and weaponry, and that's actually put them in dispute with the Trump administration. So it does give an opportunity for those other platforms to move up.
And David, we can't, of course, finish the podcast without talking about the US Federal Reserve and the RBA here in Australia. They've both got meetings this month. What are your thoughts there? What are they going to do?
Yeah, so obviously the RBA became the first major central bank to change direction this cycle, and they did deliver a rate hike at their last meeting in February. Their next decision is on March 17th. I do think there are more hikes to come, but I think they'll probably be patient and pause this month, most likely wait until May. Now, the US Fed, they meet one day later on March 18th. Personally, I think they're probably on hold for at least the next couple of months until we do get a new Fed chair taking over in June.
Very good. Well, it has been an absolute bumper episode. David, as always, thank you so much for joining us. We appreciate your insights and look forward to hearing them next month.
Thank you, Lyndon. See you then.
See you then. And that wraps up this episode. Thank you for listening. If you would like to keep up to date with these podcasts each month, remember to subscribe to us wherever you get your podcasts. You can also subscribe to the UniSuper YouTube channel or check unisuper.com.au/podcasts at the start of each month. Now, we heard from John Pearce before, but he did in fact release his latest investment update video a week or so ago. Just a friendly reminder to go and check that out. It's available on our website, and we'll also pop a link to it in our show notes so that you can check it out there as well. We are UniSuper, the place where bright minds and passionate people strive to think great and create a future worth retiring for. If you'd like to learn more about our investments, visit unisuper.com.au. Thank you for listening, stay safe, and we'll see you next time. This podcast is general in nature, and it doesn't take into account your financial situation, needs, or objectives. So before you make any decisions about your super, we recommend that you seek financial advice first. Also, make sure you've had a read of the product disclosure statement and the target market determination that's relevant to you. They are all available on our website. It goes without saying that the past performance of any investment options that we talk about isn't indicative of their future performance, and it's worth noting as well that just by talking about certain companies, we aren't endorsing them for you to include in your own portfolio. Also, probably not a bad idea to mention that certain information contained in this podcast may include forward-looking statements, and we obviously don't guarantee that those statements will eventuate. And lastly, UniSuper has no obligation to provide updates or changes to the information in this podcast.